How are short-term rental investors across the United States saving massively on taxes? We're going to go over that exact topic in today's video. Hi, my name is Zachary Jensen. I'm the managing partner here at TaxWise Financial Services, where we're empowering small business owners and high-income earners with tax savings so they can build their wealth faster and grow with confidence. In today's video, we're going to be talking about the short-term rental loophole in 2025, any last-minute things we can do before the end of the year, and how this tax strategy works, and a bit of a refresher with the latest big, beautiful bill. So first of all, what is the short-term rental loophole exactly? It's a powerful tax strategy that allows certain real estate investors to convert what normally would be passive real estate losses into active real estate losses that can offset W-2 or business income. Under normal tax rules, rental real estate is considered passive or a passive activity. This means that losses like depreciation can only offset other things that are passive, so not salary or business profits. However, the IRS classifies short-term rentals, those with an average stay of 7 days or less, differently. This opens the door to a major opportunity for taxpayers who actively manage their short-term rentals. So if you own your own Airbnb and you manage it yourself, or have a property manager that does some of the work and you do the most of the work, keep listening because this strategy is going to save you a bunch of money. To qualify for this benefit, an investor must materially participate in the management of the short-term rental. In simple terms, they must be directly involved in running the property, handling guest communication or payments, cleaning coordination, day-to-day operations. Again, they don't need to do all of this. We just need to make sure they're doing most of it, right? The rule that our firm likes to see folks go for under the material participation test is 100 hours and more than anyone else, meaning you have to do 100 hours of work and do more than anyone else. So your property manager can't do 101 hours, for example. And when this threshold is met, the activity is no longer considered passive and its losses can be used to reduce regular taxable income. This is the core of the short-term rental loophole, right? We turn what normally would be paper losses into a real tax deduction against your active income. The key driver behind these large deductions is depreciation, which allows investors to write off the cost of property over time. But through a process called cost segregation, investors can actually accelerate this depreciation. Cost segregation studies break the property down into components like flooring, furniture, lighting, appliances, and this can be depreciated over 5, 7, or 15 years instead of 27 and a half years. This front loads the tax benefits, giving the investor a large deduction in the first year of ownership. When used alongside the short-term rental loophole, this allows investors to potentially wipe out tens or even hundreds of thousands of dollars of taxable income. It really is that powerful. For example, imagine a taxpayer earns $200,000 per year and buys a short-term rental. They use a cost segregation study, and it causes $100,000 of first-year depreciation to give them a loss on their tax return. And if the taxpayer actively manages the property, that $100,000 depreciation offsets their W-2 or business income, legally reducing their taxable income from that $200,000 down to $100,000. And with states with high tax rates, this can save the taxpayer anywhere from $25,000 to $40,000 in just a single year. And that's just with one property. What if you had two? What if you had more? It can get very, very powerful very quickly. And allow you to have more money to then go buy more short-term rentals, which is another positive financial growth hack. So it's one of the few ways to use real estate to lower your taxes on active income without qualifying as a full-time real estate professional. So in summary, the short-term rental loophole isn't just a trick or a gray area, right? A lot of people ask me, will I get audited if I do this? Is this a legit thing? Yes, it's legit as long as you work with an accountant that knows real estate. Chances of audit are relatively low, and you shouldn't have any problem defending it if you do get an inquiry. It's a legitimate application of the tax code designed to encourage investment in active hospitality businesses. And by combining material participation with a cost segregation study, investors can take advantage of front-loaded depreciation to dramatically reduce their taxable income. And for high-income earners, this can be the difference between getting to their goals in 5 years versus 10 years. It's really that powerful. So if you have any questions on how you can use this strategy to accelerate your growth and building your wealth, or use this on your taxes, please reach out to us. Our contact information is in the description below. Thanks so much for watching and have a great day.